Welcome, aspirants. Today, we are breaking down the RBI's latest census on foreign liabilities and assets. And, the big story this year is its really fascinating tug of war. While foreign money is flowing into India, Indian money is actually flowing out even faster. So let's dive in and figure out exactly what this means for you. Okay, so first things first, what is this FLA census we're talking about? Well, as you can see, it's basically the RBI's big annual survey of all cross-border financial flows. In simple terms, it's tracking two key things: foreign direct investment, or FDI, that's foreign money coming into India, and overseas direct investment, or ODI, which is Indian money being invested abroad. In and out, simple as that.
So here's our game plan. We'll kick things off with who's actually getting surveyed here. Then we'll jump straight to the headline numbers on investment growth. After that, we're going to look at where the money is coming from and going to, what specific sectors it's targeting, and finally, we'll wrap it all up with the most critical takeaways for your exams.
All right, so first up, let's get a handle on the scope of this census. Who are the key players actually providing all this data? Because, understanding the source helps you analyze the findings a whole lot better.
So who exactly is reporting all this? Now, this is a super important point. This isn't just about the big flashy companies on the stock market. Not at all. The vast majority, we're talking over 97%, are unlisted companies. And get this, most of those are subsidiaries of foreign firms that operate in the non-financial sector. This context is absolutely key because it means the trends we're about to see are being driven by what's happening on the ground in the day-to-day operations of foreign companies in India.
Okay, let's get to the main event. This is the most important trend from this year's report. A perfect question for your mains exam, by the way. This is the headline story you absolutely positively need to know.
And bam, here it is, in black and white. While foreign direct investment into India grew by a really healthy 11.1%, just look at the other side of the coin. Indian overseas direct investment shot up by a massive 17.9%. So what's the key takeaway here? It's simple. Indian companies are expanding their global investments at a way faster rate. And this number right here, 5.9, it tells the whole story. The ratio of inward FDI to outward ODI has actually shrunk from 6.3 down to 5.9, and that's just in 1 year. This narrowing gap is a huge indicator of the Indian economy's growing maturity. It shows that our companies are getting really aggressive about expanding their global footprint.
All right, so we know the money's moving fast. But where is it all coming from? And where is it going? Let's move on and look at the actual geography of all this investment. These are high probability facts for your prelims, so listen up.
When it comes to the sources of FDI, the United States is the undisputed champ, accounting for a full 20% of the total. Now, to help you remember the top 3 for your exam, we've got a little mnemonic for you. Just think of the phrase, Uncle Sam made it to the top. That's USA, Singapore, and Mauritius. Easy, right?
Now let's flip it. When we look at where Indian companies are putting their money overseas, Singapore is the #1 destination. It's a major hub for Indian businesses looking to go global. And we've got another simple mnemonic to help you lock in the top 3. Just remember SUK. That's S Singapore, the USA, and the UK. Okay, so we've covered the where. Now let's talk about the what. Let's look at which sectors are actually attracting the most foreign capital. This is a really high-yield area for objective questions, so pay close attention to these percentages. Looking at the sector breakdown, wow, it is a really tight race. But the manufacturing sector just inches ahead of services, pulling in nearly half of all FDI equity at 48.4%. And notice, this is at market value. Now that's important because it reflects the current worth of these investments, not just the initial price tag. It gives us a much more accurate picture of where the real economic value is. And this data point, it aligns perfectly with the whole Make in India initiative. Now, if we drill down a little deeper into manufacturing, you can see the investment is spread out across some pretty critical areas. Sure, other manufacturing is a big catch-all category, but look at the significant shares for machinery and equipment and motor vehicles. This just shows that FDI isn't just going into low-end manufacturing. It's flowing into the core industrial sectors that are just vital for our economic growth. Okay, so the investment capital is one thing, but beyond that, how do these foreign subsidiaries actually contribute to India's trade? Well, the data here reveals a
Well, a very interesting and distinct pattern.
Here is a standout figure that you should absolutely burn into your memory. The services sector. It accounts for a massive 73.5% of the total exports that come from these foreign subsidiary companies operating in India. And a huge chunk of that is from information and communication services.
Now, in stark contrast to that, the manufacturing sector is responsible for 65.3% of their total imports. So what's the big picture here? It's pretty clear, right? Foreign firms in India have a very distinct trade pattern. They are exporting high-value services, and they're importing goods and components for their manufacturing operations.
All right, let's pull everything we've covered together into a high-yield summary. Think of these next few slides as your personal cheat sheet for that last-minute revision right before the exam. First, the big picture stuff. Remember that headline story, ODI growth is outpacing FDI growth. That is the main trend. This has caused that crucial investment ratio to shrink down to 5.9 times. And always remember the context. This data is being driven by unlisted, foreign-owned subsidiaries. Next up, your key data points. You got to memorize the top countries. USA for FDI, Singapore for ODI. Got it? And remember the dominance of the manufacturing sector when it comes to attracting FDI, pulling in a whopping 48.4% of the equity. And finally, let's lock in the trade story, because it's a great point for analytical questions. These foreign firms, they export services, especially IT, which makes up more than half their exports, and they import manufactured goods, especially electronics, which is their single biggest import category. Export services, import goods. Remember that. So all of this leaves us with a really critical question to chew on for your analytical answers. Are we witnessing a major shift, a pivot from a focus on Make in India, being a destination for investment, to a whole new era of Made by India, where we become a major global investor ourselves? Definitely something to think about. That's all for this explainer.